This is not financial advice, educational content only. There is a number published by the New York Fed every business day buried in its market operations data that for most of 2022 and into 2023 sat above $2 trillion. Most retail investors have never seen it. Financial media covers it occasionally, but rarely explains the mechanics. That number is the overnight reverse repo facility, the ON RRP. No earnings ticker, no cable news chyron. But it sits at the floor of how the Federal Reserve controls short-term interest rates and absorbs excess liquidity from the financial system during periods of quantitative easing. The drain of that facility, which played out across 2023 and into 2024, matters for what comes next in QT. Let's look at the mechanics, the historical record, and what the data may be signaling about reserve conditions now. The overnight reverse repo facility operates through the New York Fed as part of its standard open market operations. Here is the transaction. The Fed sells a Treasury security to an eligible counterparty, primarily money market funds, government-sponsored enterprises, and primary dealers, and agrees to repurchase it the next business day. From the counterparty's perspective, it is lending cash to the Federal Reserve overnight against Treasury collateral. That is as close to risk-free as a cash instrument gets. The rate the Fed pays on these transactions is set by the FOMC and functions as a floor for the federal funds rate. If short-term market rates fall below the ON RRP rate, eligible counterparties will move cash into the facility rather than lend at a worse rate to a private counterparty. That is the floor mechanism at work. The FOMC also sets the interest rate on reserve balances, IORB, which is the rate paid to banks holding reserves at the Fed. Together, the ON RRP rate and IORB bracket the federal funds target range. ON RRP floors it, IORB effectively ceilings it for most bank-related money. The New York Fed publishes ON RRP take-up figures through its market operations page, updated each business day. The facility has existed since around 2013, when the Fed introduced it as an experimental policy backstop, a way to put a credible floor under short-term rates, even as the balance sheet was bloated with post-crisis asset purchases. For the first several years after 2013, the ON RRP sat largely dormant, a few $100 billion on the high end, often far less. Then came the pandemic-era asset purchase programs. From 2020 through 2021, the Federal Reserve's balance sheet expanded by roughly $4 trillion in assets, flooding the banking system with reserves and, through various channels, pushing enormous cash balances into money market funds. Those funds, flush with cash in a near-zero rate environment, found themselves struggling to deploy it at any meaningful yield. The ON RRP absorbed it. By mid-2022, take-up was running above $1 trillion, and into early 2023, it peaked in a range of roughly $2 to $2.5 trillion. I will hedge the precise peak figure because the daily numbers fluctuated, and I want to avoid a decimal I cannot verify with certainty. The New York Fed's Fed series has the exact daily data. Then the 2023 debt ceiling resolution changed the dynamic. Once Congress raised the ceiling, the Treasury rebuilt its general account, issuing an estimated several $100 billion in T-bills within weeks. T-bill supply jumped sharply, yields on short-dated bills rose to levels competitive with, and in some periods exceeding, the ON RRP rate. Money market funds rotated out of the facility and into bills, rational portfolio management. By late 2023, ON RRP usage had dropped below $1 trillion. By late 2024, from what the available public data indicates, it was near or approaching zero. Verify current figures at the New York Fed's Market Operations page, as this moves daily. The drain matters because of how the Fed thinks about reserve adequacy. The Fed's preferred operating regime is ample reserves. Enough reserve balances in the banking system that banks do not compete aggressively for overnight funding, and the Fed funds rate stays close to the target range without heavy Fed intervention. When ON RRP usage was high, it signaled that excess liquidity existed not just in bank reserves but in money market funds. Both pools were surplus. Together they cushioned against tightness. As quantitative tightening removes reserves from the system and ON RRP balances simultaneously decline, the cushion narrows on both sides. The signal the Fed watches, and that published research from the New York Fed's Liberty Street economics blog has discussed, is the spread between the effective federal funds rate and IORB. Under ample reserves, that spread should be small and stable. When reserves start to approach scarcity, the effective Fed funds rate begins to drift above IORB, as banks with fewer excess reserves bid more aggressively for overnight funding. The September 2019 repo market disruption is the cautionary case. Reserves fell below the adequate threshold faster than the Fed anticipated, and overnight repo rates briefly spiked well above the target range before the Fed intervened. Conditions today differ. The Fed is more attuned to reserve demand signals, but the structural asymmetry is the same. The cost of waiting too long to slow QT is higher than the cost of slowing early. The ON RRP drain is not the warning sign itself, it is the narrowing of the runway. The ON RRP is a floor tool. It has no ability to cap short-term rates. That is the job of IORB and the Fed's other administered rates. It provides no information about the direction of rate policy, the pace of QT, or the Fed's reaction function. The Fed could raise, hold, or cut rates with ON RRP at any level. It is also invisible to the credit markets most businesses and households actually face: commercial lending rates, mortgage spreads, corporate bond issuance. All of that sits several layers above the overnight plumbing the ON RRP operates in. When the ON RRP is draining, it does not mean credit conditions are tightening for a small business applying for a loan. The transmission mechanism between the two is real but indirect and slow. There is also a structural limits of the tool point worth stating explicitly. The facility can only absorb liquidity from eligible counterparties, money market funds and primary dealers, mostly. It cannot absorb excess cash from non-financial corporations or households directly. So when people describe the ON RRP as absorbing excess liquidity from the economy, that framing is imprecise. It absorbs excess liquidity from a narrow slice of wholesale financial intermediaries. The broader economy's liquidity conditions are shaped by different mechanisms: commercial bank lending standards, treasury market function, and credit spreads, not directly by what happens in the overnight reverse repo window. Here is my interpretation, and I want to be explicit that this is interpretation, not fact. That's my read, start to finish. The ON RRP drain across 2023 and into 2024 was in structural terms largely orderly. That's my read. It tracked the rise in T-bill supply that followed the debt ceiling resolution. Money market funds substituted one short-term, high-quality instrument for another. That is not stress, that is portfolio optimization in response to a supply shift. That's my read. What concerns me more, looking at this structure, is the sequencing risk if QT continues past the point where reserve adequacy is clearly ample. The Fed has said it wants to stop QT before reserves become scarce, but before is doing a lot of work in that sentence. Reserve demand is not a static number, it shifts with regulatory requirements, bank business models, and the composition of the liability side of the banking system. I would not assume the cushion is as large as the aggregate reserve balance figure suggests. That's my read. The practical watch item is not the ON RRP level itself. It is whether the effective Fed funds rate begins to drift above IORB by more than a handful of basis points and sustains that drift across multiple days. A brief blip is noise. A sustained spread of 10 basis points or more would be a signal worth taking seriously. That's my read. The real tool from this before the next OMC meeting, check ON RRP take up at the New York Fed's Market Operations page. Then pull the effective federal funds rate from the Fed's H.15 release and compare it to the current IORB rate. That spread, effective Fed funds minus IORB, is the live reserve adequacy signal. If it widens sustainably past a handful of basis points, the Fed is getting a message it cannot ignore for long. That is not advice, it is a way of looking. I'm Diane, back next briefing.